Do you make New Year's resolutions?
No.
Me neither. I make resolutions every day, and they're always new.
Oh. So they're new day resolutions.
They're new day resolutions.
Daily delusions? Delusions? Daily delusions?
Daily delusions of resolutions that I should make.
A daily delusion that you're resolved
to do something. And with a new year comes a lot of new changes.
Oh, God. This boring financial...
No, there's...
Nobody wants to hear about this crap.
Well, Anthony, there's some changes that are pretty historical.
So Google
that we're going to...
Why are we putting them on a podcast? Please remember them. I have to read it off a piece of paper because there are so many damn stupid numbers that the IRS changes and monkeys with. I can't remember them. I couldn't think of a word. Like if you asked 8 or 9-year-old little Anthony Ruffalo, or if you told me this is what I would literally have thrown myself off a roof. I'd be like, this is the...
I don't think you've grown that much since you were 8 or 9.
I've grown as a person.
Oh, not height-wise. But
Very well done, Keith. Very well done. That was a pretty good insult. I like that one.
I'll share some more in a little bit.
You went height on me. Okay.
Well, that's an easy target.
I know it is.
But not for you. Okay.
That's 2.
Right in a row.
2. Keith, you're up on me right out of the gate. 2. Keith 2, Ruffalo 0. Go.
Hey, welcome back to That Financial Guy Show. I'm your host, Keith Wilson, financial advisor, here once again. Mr. Anthony Ruffalo, certified financial planner.
I don't know.
Are you certified?
I am certified.
Certified financial planner. Let's dive into these changes for this new year, 2025. First one we want to talk about 401k contributions. All right, they went up. Big deal. $500. $23,500 is the maximum contribution. The catch-up provision remains the same at age 50.
Big stuff here, ladies and gentlemen.
I know.
Big stuff.
We are going somewhere with this.
Please.
$7,500 for catch-up provision. Now, here's the big news.
Okay, what's the big news?
There's I call it a super catch-up.
A super catch-up.
Now, that's new.
What's the super catch-up?
The super catch-up is between ages 60 to 63.
Mm-hmm.
Your catch-up provision, instead of $7,500, is $11,250.
Wait a second. Hold the phone.
I know.
Is that in addition to the $7,500?
No.
Or it's a total?
Total of $11,250.
So it's...
So $23,000, what is that? $34,750 if you're aged 60 to 63. Now, this presents some planning strategies. You think about it. If you are 63 years old, you got 2 years to go before you're on Medicare, right?
Mm-hmm.
Once you go on Medicare, there is a Part B premium to Medicare. And if you make a certain amount of money, that Part B premium is higher. For example, 2025, the Part B premium is $185. If you're on Social Security, they deduct it from your Social Security. If not, you pay that on a quarterly basis. What I'm getting at is they calculate your income based on the 2 year prior.
Yes, they do. Isn't a little thing called
the IRMA star, income-related monthly adjustment amount. So if you make too much money in those 2 years prior, that's what they don't count when you retire. Mm-hmm. It's what you made 2 years because they got to have time for tax returns.
I think I know where you're going with this, Keith.
Where I'm going with this is you can plan. If you're 63, well, let's defer that income.
Yep.
Let's take care of that super catch-up provision and dump as much money into the 401k as we can to get your income lower. Some planning strategy there.
That's a great planning strategy. Yeah. A little known fact, when Keith Wilson speaks about Medicare, I would definitely pay attention and I would listen up because, one, he's almost on it, and he's super
Yeah,
close.
here we go.
But two, in all seriousness, his wife, Sarah Wilson, little known fact, is a Medicare or Med Supplement specialist.
Medicare supplement,
Med Supplement.
Medicare Advantage.
So
That's all she does.
she's really responsible for the education that's coming across right now
Okay.
in Keith Wilson.
In any case, there's a planning opportunity in that super catch-up provision age. Try to defer much as income as you can. Before we leave, talking about 401ks, in my practice, I'm sure with yours, what account, when people come to you, what type of an account reaches $1 million first normally?
I feel like this is a trick. I mean, in my experience, the most $1 million accounts from scratch are 401.
401ks.
And
Normally, because those higher contribution limits
sure,
versus an IRA. So
I would say that I see there's more frequently for the middle class. But then outside of that, then it's obviously it would be a non-retirement, like a trust account.
for the average
But for the average
person,
middle class person,
the first account that reaches $1 million is the 401k.
yeah,
And because of these higher contribution limits.
correct.
And there's a lot of, I think, advisors, you'll see it all over social. Max out your 401k. And I'm not, sometimes I'd say no, don't max it out. And it depends on the situation. I wonder if your 401k does not offer the Roth option. You also need a non-retirement account, that whole 3-bucket strategy. So just because these contribution limits are higher, you still take some financial planning. Now, let's move on to the next change, which is the SEP IRA. All right, with the SEP contributions, the limit is up to $70,000 or 25% of your compensation, whichever is lower. So SEP are mainly for self-employed individuals. And it's a way for a self-employed individual to have a higher contribution limit than a normal IRA. But you got to follow those rules. I mean, the only change there is, hey, it went from, I think, 69
And
to
where are
70.
Where are we at on the implementation of the Roth portion of the SEP?
With Simple IRA and SEP, with Secure Act 2.0, they said, hey, now you can have the Roth
portion
in your SEP. But it's up to the custodian of that SEP to implement.
Right.
Some of these have not caught up yet.
Yeah.
So you got to check with your custodian on that. But the thing about the SEP, there is no catch-up provision on that. Which leads me into the next one, Simple IRA. Simple IRA, again.
Simple IRA.
Simple IRA. It used to be Simple Trad IRA. Now they also offer the Roth, but it's up to the custodian to administer it. But you've got $16,500 is your contribution limit to the Simple IRA. There is a catch-up provision on that, which remains the same at $3,500. The Simple IRA has the super catch-up provision as well. Super catch-up at age 60 to 63, which is, what is that number?
It's not catch-up, it's Heinz. That's the marketing.
Or craft. You're very craft.
No, so when marketers can get you to use a colloquial term in place of the actual noun, they win.
They win.
So instead of ketchup or catsup, as it was called in the 50s, when you were probably in your teens, it became ketchup, and then they marketed it as it's not. There's only one ketchup. It's Heinz. Heinz. So Heinz became synonymous with ketchup.
Just like Clorox.
Instead of being at the dinner table and saying pass the ketchup, you say pass the Heinz. And that's the brilliance of the marketing. Love it.
All right, so with the Heinz,
I don't know what that has to do with finance.
The Heinz on the
the ketchup.
The Heinz. Let's call it that.
The Heinz provision.
The Heinz. We should get them to sponsor the show. So the Hines provision, as you say, the catch-up provision on the simple IRA, again, super catch-up 60 to 63 is $5,250. What about the solo 401k?
I just put one of those in place yesterday.
I like the solo 401k.
What do you want to know about it?
Why would you have a solo 401k or a SEP IRA?
A SEP IRA.
And if you're self-employed, maybe it's just you and maybe a partner or your spouse running a business. Why would you do a SEP if you could do the solo 401k?
First is employees. Second is a matter of how much income are you showing, because with the 401, you could have less income and defer more in a 401k because there's no 25% rule, straight 25% rule. You can defer up to 100% of income with up to your 23 or 23.5 for a husband and a wife
In the solo.
without the income tax. So you're entitled to do the employee deferrals, which could be 100. So if you're only showing $23,000 in income, you can defer all $23,000 in income. You cannot do that in a SEP.
You only can do 25% of that.
Correct. They both have the same aggregate limit. So if you're a high income earner, then it doesn't matter. But then you pick up the ability for your spouse to do and tax shelter money in the solo 401k as well. You can't do that in a SEP because only the owner is entitled to a SEP. You can't have a husband and a wife in a SEP. And then the third piece would be I would say the availability of the Roth portion in the solo 401k. Those have been around longer, and the SEP IRAs, although they are being adopted, they're not as prevalent. And that will change as other, like you said earlier, other custodians will pick that feature up. But up until this point, the plans that we've been working with, the solo 401k plans currently do offer the Roth portion.
It's easier to construct versus trying to find a custodian that's got a handle on it in the SEPs, because some custodians that do SEP, we're not up to speed. Not this year. And it gets me to the what'd you call it? Trad IRA, traditional IRA, and a Roth IRA, not held with an employer. It's just an individual IRA and a Roth IRA. They didn't change the contribution limits. It's the same. $7,000 is your maximum contribution you can make to an IRA or a Roth IRA. Didn't change the catch-up provision. Still $1,000.
The Hines provision.
The Hines provision. Still $1,000 at age 50.
Gotcha. Well, you know what, Keith? That brings up a good point.
What's that?
Why are IRA contributions set so much lower than 401k contributions?
It's not fair. It is absolutely not fair. I don't have the answer of why. Why is it? You're penalized if you don't work for a company that offers a 401k. And then you say, okay, I'm gonna do my own IRA and dump in $7,000 a year.
Right.
And there will be years where it doesn't increase that contribution. Years ago, golly, when I first started working, I think it was $1,500, $2,000 was the maximum contribution.
That was before the Securities Act of 1940, right?
They didn't have IRAs back then. When they started having IRAs, when I turned 50.
When you turned 50?
Yeah, when I turned 50.
50?
Yeah. In 1970, whenever they did, it was around 1,500 or 2,000.
BC?
And so it hasn't really adjusted, BC. It hasn't really adjusted over the years. So I think people are penalized, and I don't have the answer why. If they don't work for a company that offers a 401k, it's going to take you longer to grow your retirement account, which again I would say, great, $7,000 in your IRA or Roth, but you're going to have to invest outside of the retirement account in a non-retirement account. The main thing is concentrate on a savings rate, and then spread it. If you can do 25% of your income, and you can save that and earmark it for retirement, you don't necessarily have to put all 25% in your 401k or all here.
Yeah, nor would we suggest that.
You would, a big believer, you've heard it time and time again, that 3-bucket theory. It's all about taxes because we don't know what taxes are going to look like in the future.
Correct.
And then it's going to give you flexibility.
But I like that. Just hone in on so if you make 100,000, hone in on an overall savings rate of, whatever
you can do. Realistically,
25%. So I got to save 25,000, then you just break it up into 3 different places: 401k, Roth, if you can get Roth money in there, and then non-qualified after-tax money. So, and it leads me to my other things that I think are dumb in our financial system. So, number one, I think it's really dumb that there is any type of income cap or income limit as per the IRS on the ability to make Roth IRA contributions. I think that is dumb because you have the Roth 401k, which is uncapped. And it's like you're penalized. You're like, oh, I have to have a 401k tied to an employer in order to make an uncapped Roth contribution or to have the eligibility to get after-tax, tax-free money growing inside of a plan. That is just ridiculous. And I think that's unfair.
Again,
and people are penalized.
You're exactly right. You're penalized for not working for a company that offers that. Yet, all right, I'm making so much money. Let's look at those limits. Well, it's 165,000 of your modified adjusted gross income individual. You can't contribute to a Roth. 246,000 if you're married filing jointly. You can't contribute. Yeah, you can't contribute to a Roth. And again, to your point, why penalize me if I'm making more money that I can't contribute to a Roth? But if I worked for a company that offered a 401k that has a Roth option, there are no income limits.
No.
None. So let's lobby Congress or something to get that changed. That's absolutely, in my opinion, ridiculous.
It is ridiculous. And then the argument is that anybody can contribute to an IRA because you can. Anybody can contribute to a traditional IRA. The question is
it tax deductible?
Is it tax deductible or not? And that is several different tests. Are you covered by a 401k plan at work? An employer-sponsored 401k plan would be number one, the first question. The second question, if you are, how much money do you make? And the answer to those two questions will determine your eligibility to be able to contribute to a tax-deductible traditional IRA.
Yeah, that's all. An IRA is an IOU. A 401k is an IOU to the government in the form of taxes. I owe you taxes in the future.
Yeah.
I owe you in the future.
That's true.
Let's move on. There's another change on gift tax.
Gift tax.
Gift tax exclusion. So a gift tax is if you give over a certain amount of money to your children. Hey, I want to give my son $100,000 maybe for a down payment on a house.
Why would you want to give those blood-sucking animals any more money? They've taken the best years of your life already. Some
people love their children, Anthony.
That's not what you've told me.
I love my children. I'm not going to give them $100,000. All right. Anyway, if you give it over a certain amount, then the person giving that money has to pay a gift tax. That doesn't seem fair to me. You've already paid tax on it, and now you just want to give it away. But if that certain amount for 2025, the new year, is changed to $19,000. So you and your spouse can give individually $19,000 without filing a gift tax return and without paying a gift tax. Now, if you gave more than that, let's say I did give my beloved Jack $100,000 or any amount over $19,000, I would be subject to file a gift tax return because in my lifetime, they've changed this lifetime exemption. Mm-hmm. In my lifetime, I can give $13,990,000.
Well, for you, that would only be 10% of your wealth. So now,
Correct. But in my lifetime, I can give that without paying estate tax or gift tax.
Correct.
But if I give over 19,000, I have to report that to the government.
Yeah.
I don't have to pay. In this example, if I gave $100,000 to my son Jack, I don't have to pay gift tax, even though I went over the 19,000. I just file a gift tax return to report to the government, hey, I've eaten up 100,000 of my 13,990,000.
Yeah. So basically 99% of America doesn't ever have to worry about anything except possibly filing Form 709.
Except now, what's the penalty if you don't file that return?
That's a good, I don't know that.
I know that.
What is it?
The penalty is
A stern talking to?
you will owe like 5%, some percentage of the amount that you gave more than the exemption. So lifetime exemption. The 13
lifetime exemption.
So if it's a silly thing, a lot of people, and I'm not recommending this, a lot of people don't file gift tax returns if they gave over that limit.
I would highly recommend filing the appropriate form.
I would highly recommend it, but I've seen where people don't because the penalty will end up being zero. It is no big, it's a 1 or 2 pager. And essentially, the most time that it's going to take to fill out the form is your name and address and social security number. Because then you name, who did you give the money to? How much was it? Boom.
Interesting. You know what I'm thinking about? What's going on with inherited IRAs? I heard there's a lot of chatter about some changes that start in 2025 with inherited IRAs.
Yeah. So in 2020, the Secure Act 2.0, they did away with the stretch IRA with inherited IRAs. Stretch IRA on the trad. The stretch IRA before 2020, let's talk about how that works first. You inherited an IRA from a non-spouse. Maybe it was mom, dad, grandparent, uncle. Anybody, doesn't have to be a family member.
I think they got it. When you said non-spouse, I think they pretty much, the audience could figure out, it means anybody that you weren't married to.
Anybody that you weren't married to.
Which, that's 99.99999% of all other humans on the planet.
In any case, you inherit from a non-spouse. Before 2020, this IRA that you had, the government said, you will have to take a required minimum distribution, RMD, and it's based on your single life expectancy. There's a table. The way it works is whatever it's worth on December 31st, the year previous, divide that by this divisor based on your age. Voila, you get this RMD. That's the minimum you have to take out. You can take more, but that's the minimum. If you don't, it used to be, there would be a 50% excise tax on that. But the point is, if you were just taking the distributions and it's invested, hopefully it's growing, and it's growing even though you're taking distributions, that could go on for the rest of your life. And then you pass away, you leave it to your beneficiary, they're doing the same thing, thus the stretch. So in 2020, government, IRS said, no, we don't want to wait a lifetime for this tax revenue. We're going to demand that you liquidate that IRA, that inherited IRA, within 10 years.
10 years.
And that 10-year clock starts the year following the date of death of the original owner. But you've got to get it out in 10 years. Now, we as advisors, I think we had this conversation 5 years ago. We're thinking, okay, no more RMDs on an inherited IRA. We'll just strategically pull out of that IRA over 10 years. So it was very unclear until now. Earlier in 2024, IRS says, all right, RMDs are back on, required, starting in 2025 on an inherited IRA. However, they're not making you go back for the years you didn't take it because they waived it for 2020, 2021, 22, 24.
You've got RMDs, but in addition to RMDs, you still have to empty the whole thing out.
That didn't go away.
Over 10 years. So your strategic planning says your RMD is not, if you just follow the RMD schedule, it's not going to be emptied out over 10 years. So you may want to get with your advisor and strategically plan how you're going to empty out that inherited IRA on a tax efficient basis. Because you have to plan to empty the thing out.
You don't want it to build and build and build, and on that 10th year, all right, I'm going to liquidate it all. Maybe it's $500,000, $1 million, and you pay ordinary income tax rate on it.
Yeah, and maybe I'm just spitballing here. Just a thought that popped into my head. Maybe a great way to fund a sabbatical. You take a full year off of work, have no income, empty out an inherited IRA, and pay the least amount in income tax on it.
I've never heard that is
possible.
I think that's a great idea.
I mean,
that's pretty cool,
right?
If you could do it.
If it's a big if, but if you've got an inherited IRA that was left by a non-spouse, presumably a parent who gifted you some money, and like that's something special. You
take a whole year off of work,
spend it,
pull the money that you were making, the amount that you were making at work. Your lifestyle hasn't changed. Maybe pull a little more and do something.
Yeah.
Some people couldn't do that and tell their boss or workforce, "See you in a year."
No, or you could get or. As I'm thinking about, because I honestly till this very moment I hadn't thought about it, but as I'm thinking about it, if you're an executive, I work with a lot of equity compensated executives, and you have access to a deferred compensation plan at work. What you could do is you could plan that year, so that may be 1 year at work where you really max out and load up on your deferred compensation, so you tax shelter your typical W-2 pay much more than you would, and then you empty out your beneficiary IRA and you essentially keep yourself income neutral. So for example, let's say you had $100,000 that needed to come out. Well, you could turn around and you can elect to tax shelter or defer $100,000 of your income at work through your deferred compensation plan, empty out your beneficiary IRA that year, be tax neutral. You won't wind up paying more in income during your working years. But then the rub is you have to strategically select when those deferral drops are going to happen. So with deferred compensation, there are no rollovers. Deferred comp, you have to select the year in which you want that money to drop. And that's where the planning comes in. Again, another plug for a financial advisor.
I was about to say, Anthony, that sounds complicated. It is. That's exactly why a financial plan would be beneficial. Let's wrap this up.
Please.
With the Tax Cuts and Jobs Act.
God, no.
Because that's important.
TCGA.
Tax Cuts and Jobs Act.
It reminds me of TMJ.
TMZ?
No, TMJ. You know that like clicking in your jaw?
No, I don't.
You don't get clicking in the jaw?
No.
I do all the time. TMJ.
Now I forgot. Tax Cuts and Jobs Act. All right, this thing's going to sunset at the end of 2025.
Yes.
Meaning we're going to go back to the old ways. We're going to go back to the old estate tax exemption, which was $5 million, and it'll be adjusted for inflation. And we're going to go back to the higher tax rates if it's not renewed. So before the election, that was all up in the air. Is this thing going to get renewed? Now that President Trump was elected, I don't want to get political, but let's get real. There's a Republican majority in the House and the Senate. My opinion, most likely this will be extended and they won't revert to the old tax rates. You agree, disagree, or want to argue?
I don't think it's just going to be an exact renewal of
the same thing
of where we're at now. I think you'll see some slight policy changes, and I'm waiting to see if they roll out something to do with Social Security. That is married to that. Because that seems to be a hot topic, and we know that it's a ticking time bomb. 2034 is the number, and is the current administration. Do they have the political will? Are they going to tackle that now? And I think a lot of the American people want to see that tackle. They want to see that issue addressed while you have the political will to do so.
But Trump has said in his campaign that he wants to do away with Social Security tax on beneficiaries that were receiving their Social Security benefit. Because currently there's threshold, if you make so much money, 50% of your Social Security benefits are taxable. There's another threshold where it becomes 85%. Again, this is if you're collecting Social Security.
Yeah.
And he said, hey, we're going to do away with that.
Yeah. Well, a fun fact, I don't know if you know this, but Social Security became taxable in 1983. That's when Reagan commissioned the Greenspan. And Alan Greenspan at the time had put a committee together to come up with recommendations on how to bolster the solvency of Social Security. And Greenspan's recommendation, which Reagan administration implemented, was to begin taxing Social Security as a means of
shoring it up.
However, now that's my asterisk to that is, like, I understand that conceptually, but there's not a line, like, they don't take the tax revenue from Social Security and immediately put it back into the Social Security system.
Because they don't take that taxation money.
Correct.
And put it back into the trust fund.
Yeah, I
it
think
goes into the general fund, is your understanding.
Right. I think a more direct measure would be to change FICA tax, to uncap the wage base, to increase the FICA tax, to put a special. And I would hate if this happened, but it would be a simple fix if they said, you know what, on every IRA distribution or 401k distribution, we're going to have a surcharge of there's a special
like a payroll tax
on the back end. I'm not jockeying for that. What I'm saying is
that's a way.
That would be a way to bolster and shore up. It's a way of inadvertently means testing Social Security, because if you're taking distributions from your IRAs, it doesn't affect your Social Security benefits.
I haven't thought of that, but I can see.
There's a lot of things that you don't think of that I think of.
Oh, I know that. My mind is.
Which reminds me, how do you know Keith Wilson is about to say something intelligent? Because he starts the sentence with, Anthony Ruffalo once told me
this. Anyway, the Tax Cuts and Jobs Act expiring at the end of 2025. Congress has got to be the one to extend it, not President Trump on his own. So it has to do with Congress. My opinion is I think they will extend it
in some way, some form.
I don't think it's going to get worse. If you like what you're seeing so far, check out this next video. Subscribe to the channel. Lord willing, we'll see you next time.